Today we're going to talk about the two most common loans, FHA and conventional. One has a lower interest rate, but a little higher closing costs. The other one has a higher interest rate, but less closing costs. Which one's right for you? Let's check it out. Hey guys, Jeremy from CU Mortgage Direct, taking you from the closing table to your kitchen table. Today we're talking about conventional loans and FHA loans, but let's talk about conventional loans first. What is a conventional loan? A conventional loan is a loan guaranteed by a private lender or a government subsidy like Fannie Mae. These loans typically are for better borrowers, like they have a better credit score, bigger down payment, lower debt to income ratio, and the down payment can range from 3% down if you're a first-time home buyer or 5% down if you've previously bought a house. Here are some of the advantages. Unlike rural development, VA, and FHA, conventional does not charge a funding fee, so therefore typically your closing costs are a little lower. The second thing it does have PMI, but so does rural development and FHA. What is PMI? Which it stands for private mortgage insurance. PMI does you no good whatsoever. What it is if you do not put 20% down to buy a house, you get charged this monthly fee, and this insurance kicks in and helps the lender recoup the cost of the foreclosure process. However, once you have 20% worth of equity in your house, that PMI drops off, unlike FHA or rural development. Another advantage of a conventional loan is the appraisal. Sometimes it allows you to get by with an appraisal that has a house that maybe needs a little bit more repairs. What are the disadvantages? The disadvantages, and it's a big one, it's a little higher interest rate than FHA, rural development, or VA. Another disadvantage is that it is credit-based interest rate. So the other loans, they also want you to have a higher credit score, but you don't get hurt as bad when it comes to your interest rate. If you have a lower credit score, you're really going to get hammered as far as an interest rate. The third reason is it becomes a little picky trying to get a conventional loan approved. If you don't have that higher credit score, or if you have a lower down payment, it may not approve you. The next loan we're going to talk about is an FHA loan. What is an FHA loan? Well, it's governed by Federal Housing Administration, or FHA, and what FHA's goal is to make home ownership readily available for people that may have a little lower credit score, maybe higher debt to income ratio, and maybe not much for a down payment. So one of the advantages of an FHA loan is that you can have a lower credit score as long as it's above a 620. Maybe your debt to income ratio is a little high. You can kind of play around with that a little bit. It allows that. Another good thing is that it's a lower down payment. Typically it's 3.5% down payment. Now, what are the disadvantages? Well, the big disadvantages with FHA is what's called an upfront MIP, or a funding fee. They're going to charge you 1.75% of the loan amount just to do the loan. That's pretty huge. The other thing is, for a disadvantage, is, remember I talked about PMI or mortgage insurance? Unlike conventional, that drops off after 20% worth of equity, the PMI for FHA stays on there for the entire life of the loan. Lastly, if there's a home that may need some repairs that you're looking at, FHA can become a little picky when it comes to that. So what do the payments look like? Let's take a look at the numbers. Today is March 4th, 2024, and I am using today's interest rates of an FHA loan at 5.625 and a conventional interest rate of 6.125. Let's pretend you're buying a house for $200,000. Just to let you know, rates can change daily and can be erratic. That is why I'm talking about today's interest rate. So with a conventional loan, there's that 3% down payment. The payment a month is $1,242.32. FHA's payment, with a 3.5% down payment of a $200,000 house, that payment a month is $1,217.93, again with just principal, interest, and mortgage insurance. FHA is cheaper by about $24.39. Does it mean it's better? $24 is a great savings a month, especially if you spread that over 30 years. However, keep in mind FHA has that upfront funding fee. According to my calculations, it's almost $3,400 that they're going to charge you at closing compared to conventional not having that fee. So with that savings of $24, it almost takes you 11 and a half years to recoup that. Now, one of the things to keep in mind also is FHA has that mortgage insurance on there for the entire life of the loan. So over the life of the loan, conventional could be a little cheaper. Now, keep in mind also, if maybe rates drop, we can refinance you. So if you're just only approved for FHA, we can refinance you going forward in a conventional loan. If your credit score goes up, maybe you have more equity in your house. The big thing is talk to your trusted loan officer. The hard ones are when you're barely qualified for conventional, but you are qualified for FHA, and conventional has that credit-based interest rate. Those payments could be a big difference where maybe FHA does make sense. But talk to your loan officer, talk to me. Don't be afraid to ask questions. If you do have questions, give me a holler, 275-1794, or text me, and we'll talk about it. Thank you so much for watching. If you're interested in learning more about the home buying process, check out all of these videos that I have out here.